Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And yesterday delivered one of the best sessions of the S&P 500 since the start of the Iran war. We saw all 11 sectors in the positive yesterday, nearly 400 plus components of the S&P 500 advancing. Oil dropping roughly 5% here yesterday on the back of the U.S. allowing Iranian tankers through the Strait of Hormuz, and NVIDIA hosting their GTC conference and revealing that they expect over $1 trillion in orders for their Blackwell and Rubin architecture through 2027, while also at the same time unveiling their next architecture. Really shows that despite the volatility here in the market and potential inflation on the horizon, AI remains the dominant theme for investors. But despite all of that, if you look at the S&P 500, one thing you'll notice is that one, we've broken below some intermediate support here at 675 over the last week. Trend quality, as you can see, continues to deteriorate and has turned red. So as long as we stay below 675, any rallies here potentially still can still potentially turn lower from here, is our base case at the moment. Now, especially if you consider the fact that we just came off of what was one of the worst job number reports we have seen in quite some time, with 92,000 jobs lost in February. Uh, you combine that with the current situation in the Middle East and how that's going to affect oil prices. Yes, we saw oil come down about $5 yesterday, but if you look at the backwardation of the futures contract, meaning the price of oil in the front month futures versus the back month, that still remains fairly elevated. Volatility still remains relatively elevated, even though we saw that contract substantially here yesterday, both volatility and volatility of volatility contracting, both of those combined with each other, many times can provide a strong sign for the provide a strong sign for a stagflationary environment. The combination of slowing growth with sticky inflation. And this has been reflected mostly in the form of the treasury market. We saw treasuries sell off here across the board, and the 10-year yield now back above or hovering around 4.3% here. We've seen this massive sell-off here in treasuries over the last couple of weeks, driving expectations for the FOMC meeting tomorrow to essentially push back any rate cut expectations from what was expected to be the first rate cut in June. Now markets are pricing in the first rate cut not until December of 2026. So the FOMC meeting on Wednesday is going to be one of the most important ones to be paying attention to, outside of the fact that it will be Powell's second to last one as governor, because what we are looking for is how is the Fed going to, or how has the Fed's inflation outlook changed as a result of the conflict in the Middle East, which specifically impacts oil prices. You have oil, Brent still hovering around $100. WTI a little bit lower from that. The spread between Brent versus WTI remains, hovering around that $6 mark, $6 mark. Um, and the way that I'm currently viewing the conflict in the Middle East, it doesn't seem like there is a easy off ramp that gets the price of oil down substantially. Um, we'll see if yesterday's reopening of the strait, or quote unquote reopening of the strait, which it's not by any means a real reopening of the strait, does start to ease the price of oil. If that does happen, that certainly would be a step in the right direction with regards to concerns around inflation. But if it stays where it is and inflation expectations remain high and 10-year yields remain high, we start to get into a bit of a predicament with higher interest rates continuing to erode the the economic conditions that we have already started to see deteriorate with the labor market print that came in far worse than expected. We saw Empire State Manufacturing showing contraction versus what was expected, which was a pretty positive or decently positive reading actually showed contraction, which is a pretty substantial surprise to the downside. We saw Q4 GDP revised down to 0.7%, confirming the slowing growth that we start to see here in the economic data here. And everything is really paying attention to here to the FOMC meeting. At the moment, it seems like the the NVIDIA conference so far has provided a bit of a boost here overall to the semiconductor space, which, despite some volatility here over the last couple of weeks, have found some level of stability here and is trading sideways as opposed to continuing to move lower with the rest of the market. So we actually see semiconductors providing some defense in this market condition, which is typically not common. Usually, these types of sectors would see, a higher beta move here to the downside, but tech outperforming and providing some level of shelter from the current volatility that we're seeing here in the markets. Going forward, the primary focus is going to be the FOMC meeting tomorrow. We're 100% expecting a rate cut. I'm sorry, a hold to the rates. We'll see if the updated dot plot will reveal how officials are reviewing the probability of rate cuts for the rest of the year. The recent Q4 GDP were being revised lower and 10-year yields back above 4.3% is going to force the Fed to make a decision with regards to inflation, and we'll see how they respond to the conflict in the Middle East and how higher prices of oil will factor into their inflation expectations for the rest of the year. We also have Micron reporting earnings tomorrow night. We've seen Micron continue to show some strength heading into that earnings announcement, especially on the back of yesterday's NVIDIA, you could call it guidance of expecting, $1 trillion in GPU orders through 2027. That's an incredible amount of visibility into revenue that we expect is certainly going to have a trickle-down effect to the high bandwidth memory companies like Micron. And then at the same time, we have PCE data, inflation data coming out here this Friday. You have earnings data from FedEx, from Lululemon. These types of companies will start showing us kind of how the retail, or rather, those companies will potentially give us a read into how the consumer or the retail side is going to be affected by gasoline at $3.50, $4 a gallon. what they're expecting the consumer, how the consumer to respond with certainly some level of deterioration in consumer discretionary spending as a result of some significantly higher oil prices. But, the real question right now is, does oil stay above 100, maybe even above 120, 130 for any extended period of time? Because if that were to be the case, that alone could potentially send the US economy into a bit of a tailspin. Wells Fargo recently coming out with that report suggesting that if oil stays above $130 for multiple months, that could trigger a recession here in the broader markets. And that's already on top of, some of the concerns we've seen in the private credit space. If you look at most of the private equity firms, whether you're looking at Apollo or Blackstone and even BlackRock, we're seeing is not immune to this. BlackRock recently just halting redemptions on or halting a certain amount of redemptions on their private credit fund. And given the fact that a private credit fund is only a relatively small percentage of BlackRock's business, but recently breaking down below this key $1,000 level here on BlackRock and seeing all of that kind of reflect in most of the major private equity firms, whether you're looking at Apollo, you see that's recently cracked that 120 support level here. You look at Blackstone. Um, Sorry here, I think my computer might have just froze. Mm, there we go. Sorry, my computer is frozen here for a second once I get that back. But you'll see that Blackstone has broken below that key 130 level here. All of the private equity or private credit funds have seen a substantial amount of decline. And the fact that almost every single one of them have at this point, in some way, shape, or form, restricted or halted redemptions is not a good sign here for the credit market, and is potentially a sign of, a deteriorating overall economy. You see Blackstone here breaking down below this 130 support level and then breaking below the 110 support level here. Some really bearish trends that's starting to emerge here from, what has been one of the bright spots within the financial sector, really points to potentially some tough times ahead, especially if interest rates remain stubbornly high. These funds are not particularly enjoying a higher interest rate environment, or rather, an interest rate environment that's significantly higher than where we were sort of expecting interest rates to be at this time last year. We were at 4.3% maybe a year ago, expecting that by this stage we'd be significantly lower, and that would provide some relief to small caps, to private credit, and at the moment that seems to be doing, with the war in Iran, we're sort of seeing the exact opposite, and that is certainly going to have some ramifications on the broader markets. So the question is whether or not there's enough risk in some of these private credit funds to create some systemic risk in the broader financial markets, and that's yet to be seen. But we very much seem to be in the early stages of what could be a little bit of a credit crunch, and higher interest rates is certainly a a factor that has to be contended with in that regard. So with that, taking a look at some of our opportunities here right now, some of the names that I think are worth paying attention to here right now. One, we have a Charter Communications recently triggered a bullish trend following signal here, as you can see, after what has been a strong underperformance here for the stock. The stock has finally formed what feels like a bit of a bottom here. Um, so if you kind of see this bottoming formation, and this 215 level has been an important level for that bottoming formation. We broke out above 215, traded all the way to 250. We've now pulled the way all the way back to this 215 level here. And this is really where the opportunity from a risk to reward perspective looks quite skewed to the upside. You have improving relative strength, improving relative trends of the stock pulled back to a major support level. The risk to reward looks incredibly attractive for some upside potential from where we are right now. The next one I want to take a look at here within AI, you have applied materials. Applied materials, one of the main components in terms of equipment or fabrication manufacturers for high bandwidth memory and advanced GPU chips, continuing to trade higher here. As you can see, every single time it kind of reaches this trend line, it kind of bounces higher here, and that's really what we've gotten recently is a bit of a pullback as due to the Middle East conflict. We've seen some volatility here in the markets, but despite all of that, like I said, AI has uh, become a more defensive industry at the moment, given just the sheer amount of revenue visibility we continue to see from that industry, providing kind of the downside support for a lot of these stocks. And we're looking for that recovery back towards that $400 all-time high for applied materials. Another one to take a look at here is Teradine, which is a company predominantly focused on testing within the fabrication manufacturing process. Pulling back here recently, traded up as far as high as 350, pulled back nearly $100 here to the 260 level here. Whoops. Didn't mean to do that. Pulled back to the 260 level here, started to play a bit of a bounce here, and we're looking for that continuation back towards that 350 level here. Teradine, not a household name, and for those who may not have done such a deep dive into the semiconductor industry, is also not a name that comes up very often. Obviously everyone knows about NVIDIA and Intel and AMD, but as part of the fabrication process, there are a lot of different companies that are involved in the entire ecosystem of the fabrication process, and Teradine is very much involved in sort of the latter phase of the equipment manufacturing. Operates in a bit of a duopoly market within that testing space. So up 4% here yesterday, as you can see on the back of NVIDIA news. We're seeing some upside potential here within the AI space. And then looking at the um, the oil and gas sector, which it's hard to ignore that sector here right now. I think Halliburton is one that is currently being sort of overlooked a little as a result of just the momentum chasing we've seen in the oil space. It's very obvious that big integrated oil companies like Chevron and Exxon and um, Phillips 66, all the brand names that you might be familiar with within sort of the energy space that are highly correlated to oil, but at the same time don't have any exposure to the Middle East, are benefiting from the higher oil prices right now, even even within liquefied natural gas. We're seeing kind of both oil and natural gas being trapped in the Middle East, being a beneficiary for U.S. energy plays because, U.S. energy for the most part is just directly correlated to the price of oil, and oil goes higher. These oil stocks go higher. And at the same time, most U.S. energy names have very little exposure to the Middle East. So that's really why, the XLE, the energy ETF, is the best performing ETF or best performing sector in the market right now. And in the short run, you have your Chevrons and Exxons that are, Cheniere Energy that are benefiting from just simply higher oil prices and higher gas prices. But longer term, especially if this conflict in the Middle East goes on for a little bit longer than people expect, you have the oil field services companies like Halliburton and Schlumberger, Baker Hughes, that will benefit from the decision to start diversifying away from the Middle East to other oil sources. So we've already seen an acceleration in offshore drilling, even prior to the conflict in the Middle East. If we continue to see oil supply being constrained out of the Middle East, that potentially triggers the decision to start drilling in other places, including Venezuela and oil field services companies like Halliburton benefit from that. So in the short run, they don't benefit from the current conflict. If anything, they might actually get hurt a little bit just being caught in the market volatility here. But companies like Halliburton will in the long run, be a potential beneficiary from what we're seeing here right now. But, you can always take a look at Chevron, which is going to be the largest, most liquid integrated oil company here. As you can see, recently just generated a counter trend bearish signal, which just simply means that this stock has run so far, so fast in such a short period of time. There's a higher probability of some form of consolidation or a short-term pullback here before the market kind of continues to move higher here. So that's just something to be careful of if you are chasing the current momentum here in oil. It's just from a statistical perspective, it's run so high, so hot that now is probably not the best time to buy and hope that it just keeps going higher, that you're better off being a little bit more patient, waiting for a little bit of a pullback here before you look for further upside. And then I'll leave you with one last one, probably a name that you may not have heard of, which is Powell Industries, um, specifically within kind of if you look at NVIDIA, if you look at NVIDIA and what the jobs report that just I'm sorry the number that they just came up with yesterday with regards to $1 trillion expected with regards to orders for the Blackwell and Rubin architecture. The companies that kind of provide the electrical work for these data centers, right? So the $1 trillion in spend that hyperscalers and tech companies and foreign governments are spending now to build out their own AI infrastructure. The biggest bottleneck in that AI infrastructure is power or electricity rather. In most parts of the world, with the exception of maybe China, there's a pretty tight constraint on electricity, and the expansion of that grid is not as straightforward as most people might think. In the US, electricity capacity, there's not a lot of room for data centers to grow at the pace that they're expected to grow at. So these data center companies have been forced to essentially source their own electricity. Most of them have signed long-term nuclear deals, but many of those will take multiple years to come online. In the short run, a lot of these companies are kind of filling the gaps with natural gas and potentially building natural gas plants on site to provide that reliable electricity. But to actually connect the power generation to the data centers, those transformers, the grids, and the utilities required to do that Those that is arguably the biggest bottleneck. And Powell Industries provides the um, the components for that electrical grid, and is probably a name that's not on your radar, but worth taking a look at here right now because, as you can see, the stock has been on a tear. It was a $300 stock back here in November, was a $600 stock back here in February, and now has pulled back, below 500, a little bit of a pullback here and potentially, on the back of the NVIDIA earnings that we saw, or NVIDIA announcement yesterday, shows that the pace at which we expect data centers to grow over the next couple of years just continues to accelerate. And power grid type companies are the net beneficiary of that outside of kind of the most obvious semiconductor tech based beneficiaries. So power is probably one of the least sexy industries, but it is the one is arguably one of the biggest bottlenecks in the data center build out. So worth taking a look at Powell Industries. There are obviously lots of other power companies worth taking a look at, but this one recently generated a buy signal, and I thought is worth mentioning on today's call. With that, that covers what I wanted to share with you here today. A lot to take in here right now in the broader markets, a lot of macro concerns to be aware of and stay on top of, especially out of the Middle East. Higher oil prices, FOMC meeting, and the tremors that we continue to see out of the private credited space and what that means for potential systemic risks to the financial institutions. So a lot to keep track of, but that's really why we're here every single week to keep you abreast of what are the most important macro things to take a look at, and also what are some of the best opportunities we see here in the broader markets right now. With that, that's what I have for today. I hope you guys have a great trading day, and I'll see you guys here next week.